Welcome guys to the next tutorial in the options trading strategies tutorial series. Today we are going to discuss bear spreads. So a quick revision on what spreads are. Spread is when you create an options position which combines two or more options of the same type. So aka if you let's say buy a call and sell a call, that's something of a spread. So bear spreads are the ones that are used when you expect bearish price action. The first kind is called bear put spread. The reason it's called bear put spread is bear because you're expecting bearish price action, put because you're going to combine puts to create this spread, and in this kind of spread we pay premium. Let's see how. So usually when you're seeing a box breakout and you're expecting a price to go lower, you will simply buy a put. But in that case you pay the premium. Yes, your gains are uncapped. You know, the stock can virtually go to zero, but that's unlikely. Now, if you want to reduce the amount you put at risk and maybe even cap your gains, what you're going to do is you buy the normal put as usual, but you also sell a put in order to gain some premium. So that reduces the amount of risk you put in initially, and it caps your gains, but it reduces your risk. So let's look at an example. Let's say we have a stock that just broke down, and let's say the stock price right now is 45. So to put on the bear put spread, if you do a regular put, let's say you bought $40 puts on it, all right? You paid some premium and you know your max gain is uncapped because the stock can go to zero. Now, let's say you do not want to pay that much premium, you want to reduce the amount you put at risk. What you can do is you sell a $35 put on the position. So what that does is it brings some money back in, and the amount you pay for premium is reduced overall. So let's say in this example, the stock price right now is 45. We bought the put at, with strike 40. We sold the put with strike 35. And in overall, we paid $200 of premium. Now, what would be the payoff on the expiration date for us? On the expiration date, if the stock price is above 40, then both the puts expire worthless. In which case, we simply lose the amount we paid in premium, which would be $200. It's done. If the stock price is less than 40 but above 35, in which case this 35 put will be worthless. We just pocket its premium, and this $40 put will have some value. So that will help our payoff increase, and after a certain amount it can be positive. In this case, above if the stock price is below 38, it will be positive. Why? Because from the $40 put we will be able to make up for the premium, and then whatever we get below 38 will be the positive amount that we pocket. And if the stock price on expiration date is below 35, in that case we net this total amount because we have the $40 puts. We sold the $35 puts, so we net this entire $500 worth of value. And since we initially paid $200 in premium, the final payoff for us would be $300. So you can see how our payoff got capped once stock price goes below 35, but our premium, the amount we paid, is also capped. And this is why people use bear put spreads, in order to risk less and to get a certain amount of payoff. Next, we move to bear call spreads. Again, it's called bear call spread. Bear because we expect bearish price action. Call because we use calls to make this spread. The way we create this spread is we'll buy a call with strike K1 and we'll sell a call with strike K2 where K1 is greater than K2. Let's look at an example. I think the K1, K2 will make more sense. Let's say in this case, the price of the stock is 30, all right? And we're expecting it to go lower. So at this point, you should intuitively know, and that works for both calls and puts, the option whose strike is closer to the stock price is more expensive. So if you have a $45 stock price right now, the $40 put is going to be more expensive than the $35 put. Why? Because it has a higher chance of being in profit on expiration date. Same thing, if the stock price is 45 right now, a $50 call will be more expensive than a $55 call. Why? Because it has a higher chance of being profitable on expiration date. So the option that's closer to the stock price is going to be more expensive. That should be intuitive to you guys. So in this case, let's say we have a stock price at 30, okay? Okay, so how will we set up this bear call spread? We expect the price to go lower. We want these calls to expire worthless. The option whose strike is closer to the stock price is going to be more expensive. So what do we want to do with it? We want to sell it. And the option that's farther out is going to be less expensive, so we buy it in order to cap our risk, all right? Because if you sell a naked option, your loss is uncapped. Your risk is infinite and you don't want to do that. So you want to cap your risk. How do you do that? By buying another option that's cheaper. So you will cap your risk that way. If the stock price is 30, what we are doing is we are selling this $35 call. It's more expensive. We are buying this $40 call, which is cheaper. And what that does is overall, because we are selling the more expensive thing and buying the less expensive thing, we are getting premium in order to put in this position. Alright, so initially, if the stock price on expiration is below 35, then both these calls expire worthless and we pocket the entire premium that we were paid. Alright, because we're expecting bearish price action, so we want these calls to expire worthless. Now let's say the expectation we had was bearish price action, price started to rise a bit. Till when will we be profitable? We'll be profitable, we'll have some premium left as long as stock price is below 37 on expiration date. If the stock price is at 37 on expiration date, then this entire premium of $200 is lost and we would have a break-even position. Above this, what happens on expiration date is this $35 call is valid. So I'm talking about in 35 and 40 range. So in this range, because this $35 call is valid, if the stock price is between 35 and 40 on expiration date, we will have to pay some amount for it because we sold that call. That's why if stock price is above 37 on expiration date, we will lose out the amount of value, above the premium. So let's say if it's at 38 on expiration date, then the amount that we have to pay is $300. We'll be down on the call that we sold, but we pocketed a $200 premium. So if the stock price on expiration date is 38, we will be down about $100. Now, if the stock price is above 40 on expiration date, in which case we are going to take this entire $500 hit because we sold the 35 call and we bought the $40 call. Since we pocketed a $200 premium to begin with, we will be down $300. Then what you have to do is take some real life examples and put it on paper. After some time, this thing will become intuitive. And obviously in the next tutorial video, I will go on a live chart and show how you're going to place these spreads based on the breakout scenario itself, which will make it more intuitive. But the basic things that you should always remember is the option that's closer to the stock price is going to be more expensive. And how to get this intuitively, like when you're paying off premium and when you're getting premium to put on a position and the difference between the two. So put off these payoff structures, use some examples on a paper account, and this thing will become intuitive to you. And we'll see some live examples in the next tutorial videos.